Good morning, everyone, and welcome to our release of third quarter 2024 performance results for FDIC insured institutions. The banking industry continued to show resilience in the third quarter. Though the industry's net income declined from the previous quarter, that decline was actually driven by one-time gains last quarter that were absent from the results this quarter. The industry's net interest income and net interest margin increased this quarter. Asset quality metrics deteriorated modestly, but remained generally favorable despite continued weakness in several loan portfolios, which we're monitoring closely and which I'll describe further in my comments. The banking industry's net income of $65.4 billion in the third quarter was a decrease of $6.2 billion, or 8.6% from the prior quarter. But as I mentioned, that was mainly due to the absence of one-time gains on equity security transactions of about $10 billion that occurred last quarter. The industry reported an increase in net interest income of $4.5 billion this quarter to partially offset the absence of those gains. Community banks reported net income of $6.9 billion in the third quarter. That's an increase of 6.7%, driven by higher net interest income and non-interest income that more than offset higher non-interest and provision expenses. The net interest margin increased for all size groups in the banking industry. For the first time since the second quarter of 2023, the industry reported an increase in loan yields that exceeded the increase in the cost of deposits. As a result, the industry's net interest margin increased 7 basis points to 3.23%. That reverses a three-quarter trend in which the industry's margin fell by 14 basis points. For community banks, the net interest margin rose 5 basis points this quarter after increasing 7 basis points last quarter. Unrealized losses on available for sale and held to maturity securities declined $149 billion to $364 billion in the third quarter. Long-term interest rates, in particular the 30-year mortgage and the 10-year Treasury rates, declined significantly during the quarter, increasing the value of securities reported by banks. However, increases in longer-term rates since the end of the third quarter would likely reverse most of those improvements in unrealized losses if measured today. The industry's total loans increased by $77 billion, or 0.6% in the third quarter. The largest portfolio increase was reported in loans to non-depository financial institutions, while consumer loans, mostly credit card loans, also drove loan growth. The industry's annual rate of loan growth increased in the third quarter to 2.2%. Total loans at community banks increased 1.1% from the prior quarter and 5.5% from the prior year, led by commercial real estate and residential mortgage loans. The industry's asset quality metrics continue to be generally favorable despite continued weakness in credit card, auto, commercial real estate, and multifamily housing portfolios. The industry's overall past due and non-accrual rate increased 6 basis points from the prior quarter to 1.54%. That's a level that is still well below the pre-pandemic rate of 1.94%. However, the industry's credit card, auto, CRE, and multifamily past due rates increased from the prior quarter and are above their pre-pandemic averages. Past due loan balances continued to increase in the industry's non-owner-occupied CRE loan portfolio in the third quarter. Weak demand in office space continues to soften property values, and higher interest rates over the past few years are affecting the repayment and refinancing ability of office and other CRE borrowers. The industry's past due rate for non-owner-occupied CRE loans increased in the third quarter, though at a much slower rate than in prior quarters, but still was at its highest level since the third quarter of 2013. The increase in non-owner-occupied past due loans was largely driven by office loans at banks with more than $250 billion in assets. However, those banks tend to have lower concentrations of such loans in relation to total assets and capital than smaller institutions, mitigating the overall risk to those large banks. The next tier of banks, those between $10 and $250 billion in assets, have greater concentrations in non-owner-occupied CRE loans and reported higher past due rates than the pre-pandemic average in the third quarter. Banks with assets below $10 billion reported non-owner-occupied past due rates near their pre-pandemic averages. The industry's quarterly net charge-off rate decreased slightly to 0.67%, but remained elevated at 16 basis points higher than the prior year's rate and 19 basis points higher than the pre-pandemic average. The credit card net charge-off rate decreased in the third quarter, but remained 100 basis points above the pre-pandemic average. Domestic deposits increased this quarter by $195 billion, or 1.1%, with growth widespread within the banking industry. Estimated uninsured deposits drove the increase, as insured deposits were roughly flat quarter over quarter. Brokered deposits declined $47 billion, or 3.6% from the prior quarter, contributing to the lack of growth in insured deposits. The number of banks on the problem bank list, which encompasses banks that have a CAMELS composite rating of 4 or 5, increased by 2 institutions this quarter to 68 banks. The number of problem banks was within the normal range for non-crisis periods of 1 to 2% of all banks. Total assets held by problem institutions increased $4 billion to $87 billion during the quarter. The deposit insurance fund balance increased approximately $3.9 billion from the end of the second quarter to $133.1 billion on September 30th. The reserve ratio of the fund, that's the fund balance relative to insured deposits, increased 4 basis points to 1.25% this quarter. The reserve ratio currently remains on track to reach the 1.35% minimum reserve ratio by the end of 2026, before the statutory deadline of September 30th, 2028. In conclusion, the banking industry continued to show resilience in the third quarter. However, it still faces significant downside risks from the continued effects of inflation, volatility in market interest rates, and geopolitical uncertainty. Those issues could cause credit quality, earnings, and liquidity challenges for the industry. And in addition, as I noted, weakness in certain loan portfolios, particularly office properties, credit cards, auto, and multifamily housing loans, continue to warrant close monitoring. And these issues will remain matters of ongoing supervisory attention by the FDIC. Let me conclude by saying that, as I'm sure many of you are aware, this is my last presentation on the quarterly banking profile. I would like to thank all of you for your attention to these reports. Since the QBP was established in 1986 by then FDIC Chairman Bill Seidman, it has been a reliable source of information to the public, to policymakers, and to financial markets on the condition of the banking system. I am confident that the QBP will continue to serve that important public purpose, and let me say that I am grateful to you all for your coverage of these reports, which I think further enhances the public understandings of the QBP. With that, that concludes my remarks, and I'd be glad to take your questions.
Thank you. Our first question is from Pete Schroeder of Reuters. Go ahead, Pete.
Hi, Chairman Gruenberg. Thanks again for hosting the QBP. I just wanted to ask about the update to the problem bank list. Obviously, there's a pretty sizable jump in the assets that are now included in that category. I know you can't speak in any greater detail about the banks on the list, but can you talk about just what is the significance of being put on that list? Are there additional supervisory ramifications? Just what's the significance of that?
Well, the list is made up of banks that are 4 and 5 rated on our CAMELS rating system for the supervision of institutions. I mean, what it suggests in this case that there were a couple of additional institutions that fell to a 4 or 5 rating. For those institutions, that's a consequential development which will result in heightened supervisory attention for those institutions. I do think the increase of 2 institutions and the shift in the assets overall by problem banks is still within the historical average, as I mentioned, of 1 to 2%, which is not atypical for relatively stable periods in the banking industry. So we certainly pay close attention, especially to the individual institutions that may be having heightened supervisory issues resulting in the downgrades. I think from an aggregate perspective for the industry, I don't know that the shifts in this quarter were particularly notable. Thanks for the question, Pete.
Our next question is from Ryan Tracy at Capital Account. Go ahead, Ryan.
Ryan, I think you're on mute.
Hi, is that good? Is that better? Can you
hear
me?
Yeah, now we can hear you.
Thanks. So I wanted to ask you, Mr. Chairman, about an issue that's been getting a lot of attention recently, and I think it's going to get a lot of attention in the next Congress as well. So I wanted to get your perspective on it before you leave, and that is this issue of debanking of the crypto industry. There have been some documents released under a FOIA request that was funded by Coinbase that came out in the past week that are being interpreted to indicate that the FDIC was sort of leaning on regulated institutions to stop doing business with people in that industry. And then there have also just been, broader accusations made on Joe Rogan's podcast and other platforms that have gotten a lot of attention around this. Can you just address this notion? What has been the FDIC's supervisory posture towards banks who work with people in the crypto industry, and what do you say to the accusations that this is somehow like Operation Choke Point 2.0?
Ryan, thanks for the question, and let me try to respond. First, the FDIC does not debank crypto firms in terms of their depository relationships with banks. We've had a long-standing policy under which we've said that as long as a bank complies with applicable statutory and regulatory requirements, they are neither prohibited nor discouraged from serving any customer. So in terms of access to deposit accounts, transaction accounts, there's simply no issue there in terms of debanking. In terms of banks engaging in crypto asset activity, either on or off of their balance sheet, that has been a subject of supervisory attention by the three banking agencies, that those activities can raise safety and soundness, consumer protection, and money laundering issues. And the three agencies have issued guidance in regard to those risks, which I think is quite appropriate.
And what about this line in the letter that's gotten some attention that, again, this was an FDIC letter that was released under FOIA, partially redacted, that says basically it shows supervisors asking banks to, quote, pause all crypto asset related activity. What's the context for that?
Thanks for raising that. Back in April of 2022, when there was growing interest in crypto asset activity, the FDIC issued a public financial institution letter in which we asked the banks that we supervise to let us know if they were engaging in crypto asset activity or planning to do so. And if they were, we asked them to explain to us the nature of the activity they were engaging in or was interested in engaging in. And the purpose of those letters was to inform ourselves about which banks were engaging in the activity and the nature of that activity so that we could provide supervisory feedback to the institutions. And we did send letters to the institutions providing them feedback on the information they provided us. In some cases, we asked them to pause the activity to give us some time to evaluate the nature of the activities they were engaged in and the risks before providing them supervisory feedback. I think that's the context of the letter that you referenced.
Okay. So it's incorrect to interpret it as sort of asking them to debank someone, is what you're saying?
Yes.
Okay.
I mean, just to be clear, we should separate the two, but the purpose of the letters regarding crypto asset activity by the banks was to give them supervisory feedback on that, as opposed to the issue of accounts by crypto firms in banks, in which I think there's no issue at all.
Well, isn't it hard to separate those two things? Like if you to express a supervisory concern, couldn't a bank interpret that as a warning to stop doing business?
Well, in regard to deposits, there's no supervisory concern. In regard to asset activity, crypto asset activity on or off the balance sheet of the bank, it does pose risks. The agencies have issued guidance in regard to it, and it's appropriate to provide supervisory feedback to the institutions in regard to those risks.
Thanks for your indulgence.
Sure.
Our next question is from Katanga Johnson at Bloomberg. Go ahead, Katanga.
Chair Gruenberg, thanks so much for taking our questions at this and many of the QBPs. I wanted to take a step back and just ask if there's anything that you think in the steady stream of news that has been written about the agency over the last year, 2 years. Are there things this will be your last QBP that you think have gone overlooked or that you'd like to underscore? Maybe there's something you'd like to say to the person who'd be sitting in the chair as of next month. Just wanted to open the floor to anything you'd like to add beyond just today's report.
Katanga, thanks for giving me that opportunity. I would underscore the importance of the FDIC to maintaining the stability of the financial system of the United States and the public's confidence in that system, and the importance of the FDIC's continued role. And I do think, in particular, in the FDIC's handling of the three large regional bank failures last year, the interventions we undertook in collaboration with the Federal Reserve and the Treasury Department really helped to contain what could have been a very challenging situation that could have evolved into a full-blown financial crisis. It was still, those three large bank failures were still a significant disruption to the system, but it could have been far worse. And I do think the FDIC played an important role that really made a difference. That, to me, is indicative of the importance of the FDIC in our regulatory framework. And I think it's a great opportunity and responsibility for my successor to continue carrying out the important mission of the agency.
Our next question is from Michael Stratford at Politico. Go ahead, Michael.
Hey, Chair Gruenberg. I wonder if you might take a minute to reflect on where you see the board headed after you leave. Obviously, there'll be a different majority that has a different perspective. How concerned are you that much of the agenda you enacted will be reversed, or do you see there are areas where Republicans may keep things you did? What do you see most at risk of being changed?
I generally refrain from speculation. I would say that, elections matter, and there's going to be a change of leadership and a change in the composition of the board that no doubt will result in different perspectives relating to the policies of the agency. But let's see how that plays out. And let me say at the outset that I wish my successor well, and am hopeful that under the new leadership of the agency, it'll continue to carry out its important mission effectively.
Thanks.
Sure.
Are there any other questions before we conclude today's live stream?
Perhaps, Amy, could let me come back on Katanga's question if I could, because I should probably mention, the workplace culture issues that were identified at the FDIC. And let me say, I think the agency has a very strong commitment across our leadership and throughout the employees of the FDIC to address those issues. And I think we've made significant progress in doing so in terms of implementing the recommendations made from our own action plan and the third-party report that was done. And I particularly identify the selection of an independent monitor and an expert third party as recommended in the report, as well as the establishment of 2 new independent offices at the FDIC outside of the management structure, reporting directly to the board, that'll have a responsibility for all misconduct at the FDIC, including the reception of complaints, arranging for independent third-party investigations of complaints, and determining discipline if misconduct is substantiated. So I think those are all meaningful steps in progress. There's a lot more we could talk about, but you asked about events over the past year, so I thought I should probably reference that as well. Sure.
Seeing no other questions, we'll go ahead and conclude there. Media are welcome to remain on the line to speak with senior staff about any questions they may have on the quarterly results. Thank you all for joining today.
Yeah, let me say thank you to all of you. I really value the work that you do and value the working relationship that we've had. So thanks a lot.